Good evening, everyone. Hey, on my walk, and I had to do my recording today for phase 1, 75 hard. Sorry, I look like this. Yikes. It's been a long day. I actually got a lot done today. Did a cold email blast, so I wrote the whole campaign, cold email campaign, and sent it out. So there's about 600 contacts out. I'm hoping to get, I don't know, 1, 2, 3%. That'd be great. It's probably gonna be more like 0.5%, but that's okay. We'll see where it goes. But also got some LinkedIn ads out for Humanize, as well as Meta, Facebook, Instagram, pay-per-click ads out as well, or paid ads out, I should say. So it was a good day, and made me think. I did do my learning this morning. Wasn't really anything, I don't know, it was more introspective for me than it was probably something to share, but started thinking about some of the things I take for granted that I just know that might be interesting to you. And it's just something as simple as, I don't know, the financial statements. And I was surprised about how many people in business have no idea how to even look at these financial statements, let alone what they are. And this isn't going to be probably the most interesting thing to everybody, but it is important. And I'm going to try to make it a little interesting, because it is really, if we aren't measuring what we're doing, you don't know where you're going. And I had a good coaching meeting today. I have my coach, and we're talking about the metrics of these ads, and what the yield I wanted to get from them, and the knowing every step I took, and why I spent as much as I did on the ads, and how much I wanted to yield back. And actually got me thinking about a conversation I had with a business partner of mine, Matt, about he was talking about a D1 college athlete. He's still a young kid, but he does I guess some kind of track. I think it was hurdles. I'm probably wrong, but I don't know much about track. So anyway, the question came up is, well, how many steps is the race? And he's like, I have no idea. You don't know. And so how, if you aren't measuring how many steps are in the race, and that's what you're doing, and that is what you want to do, and you want to be better than yourself than you were yesterday and the day before and the day before, how do you know if you're better? Just time? Okay, well, how do you get better at the time? Well, you shave off steps, or you shave off distance by your strides, or I don't know. I guess that's not necessarily my wheelhouse, but the idea is they kept track of metrics, and if you're going to be a professional in what you do in your business, you need to not only keep track, but you should really know what these 3 financial statements are about. And the last thing I want to talk about is strategy, specifically a SWOT analysis. Again, these are things that I learned and have been doing for a long time, and I brought it up to someone and they had no idea what I was talking about. And I guess I just assumed everybody knows these things, and it's okay. I mean, I don't know everything. I don't know a lot of things. The more I know, I don't know. And the idea of measuring and then having a strategy kind of fits in to what we've been talking about for our personal lives, and coming up with visions and goals to meet the visions. Well, this is the business side of it. So there's 3 financial statements that are important. Again, I'm walking in the dark with a ring light, so I don't want to fall over. So if I stumble or I look away, it's because I'm trying to figure out where I am and not trying to die or run into a car. Um, ooh, uneven road. Anyway, there's 3 financial statements that you should really have, and these are the 3 universal financial statements for any business: the profit and loss statement, or income statement, the balance sheet, and the statement of cash flows. And they all interconnect and work together. But the idea is the profit and loss, or the P&L is also called, or the income statement, are all the same thing. There's other phrases for it, but that's usually what it's called. This is, quite simply put, what you started with, your revenues brought in, minus what you spent, gives you what you made. Now, that's a very, very, very oversimplification of what it is, but it's the measurement of everything you brought in for that period of time. It's over a period of time. It's not one day, or, well, if it is one day, it's the P&L for one day, which is a unit of time. It's one 24-hour period. Most of the time, it's for a month, and then a quarter, 3 months, and also for a year. But why that P&L is so important is because it measures all of your revenues for that month, quarter, or year, and it measures all of your expenses, and it keeps a record of all of those things, which will be very important to compare year over year or month over month. So in business, there are seasons, and if you've been in business long enough, you understand that some seasons you have a lot more revenue, and some seasons you have a lot more expenses. And I'm not talking about fall, spring, summer, winter. I'm really talking more about, depending on your business, if it's retail, if you have the holiday season, Christmas, and the Black Friday stuff. But anyway, your marketing and your advertising are going to be heavier expenses before the revenues come in, most of the time, especially smaller businesses. So you might have leading expenses that generate revenue, and this income statement keeps track of all of that. It's not your budget, but your budget usually uses your income statements to predict the future. I didn't really think about getting into the budgeting, but income statement's very, very simple. It can get really complex if you start talking about unearned income and different types of earnings before interest and taxes. I'm not really going to go into the nitty-gritty of this. This isn't for that. I'm not trying to get into a master's level class of accounting. This is more just an overview. For those that might not know. So that's your P&L. And if you're a small business, lay it out every month. Write down what your expenses, categorize them, so it's not like you're not putting like Target, you're not putting down like receipts in there. What you're doing is you're defining categories, and usually it's cash and your asset, or your I'm sorry, that's balance sheet. Your revenues are what do you do to bring in money, and you can even sub-segment that into different verticals of revenue. If you want to start measuring your retail sales versus your services versus product A, product B, service C. And again, that gets a little tricky, but that's your revenues. And expenses, you want to make sure that there's your rent, prepaid insurance, you have all of your gas and utilities and fuel expense and usually you have some kind of expense to purchase your product. So there's your cost of goods sold, and professional expenses, marketing expenses. That's the type of categorization of expenses that I was talking about. Now, you take your what you made minus what you spent, and you get your net income, net loss. So within that whole framework also, there's an interesting number called net operating income. So your net operating income is, all that means is that you've taken something out of it, right? Or you've added things together, I guess, is another way of looking at it. They've been netted together or they've been netted out. Net operating income is basically your revenues minus what it cost to put it together. Not your employment expenses and taxes and all that stuff too, but not that. It's basically what it cost you to make that product or put together that service, and you take what you paid or what you received minus what it costs you to do it, and that is your net operating expense, or net operating income. So, what is that important? Well, what's important is that is, and you can unitize that, especially if you have all of your products separated out. You can say that if I sell this many units, now you can kind of come up with an idea of how many units you need to sell to make a certain amount of money before you take out rent and all of the other expenses that you're going to find in your company that you know what they are. So, sorry, this sidewalk's a little narrow and I don't want to die. So that's the P&L in a nutshell, and how you kind of use it is, that's your score sheet for the month, quarter, or even year. And it's also your benchmark for your budgeting moving forward. So your balance sheet, which is the next very important thing, there's 3 components to it. There's more than that, but overall arching, there's 3 components. You have your assets, your liabilities, and your owner's equity, which is basically the capitalization, which is where capitalism comes from. That is what you're trying to do. You are trying to build up your capitalization. That is the goal of business. Because what assets are things that the company owns. Your cash, again, prepaid assets or assets, prepaid insurance. It's because you have it, you've already paid for it, and you consume it over time. So that's an asset. Your building, your automobiles, any equipment you have, and these are the things that you can depreciate, and that depreciation is pretty much, it's twofold. One is everything has a life, a mean time between failure, or a life of some sort. Even my brother and I were talking about houses. We were talking about BlackRock and how they're buying up all these homes, and they only have a certain life. Well, if it's corporatized and they have the capitalization, it doesn't matter. Once it's used its purpose, once it's depreciated to zero and actually used to zero, They just bulldoze it, build it up, get loaned the money, and build the new house and start all over again and rent it. And that's kind of scary for middle America and lower America to kind of doom us into perpetual renting. It's another story, but liabilities. So I talked about assets, what they are. They're things that make you money. It's the easiest definition. It's rich dad, poor dad definition. The things that make you money or give you a return on are assets. Liabilities are the opposites. They're the things that you have to pay. Those are your loan payments, your taxes that will be due, your payroll that you have to pay eventually, accrued, which is just a fancy name for you've counted it and you've put it aside for paying later. So anything that's accrued, any accrued liabilities, those are things you have to pay. And that also includes anything that your company has taken in but has not produced yet. What do I mean by that? So, let's say you're a service company and you take a down payment and you have to produce the job. Well, if you don't produce that job, it's theft by contract. It's actually jailable in Wisconsin, at least it is. I'm not an attorney. I don't know. I'm not giving any advice. This is just me thinking top of my head. But the remainder of that contract is an asset. However, because you have a contract, right? However, the amount that you have to fulfill, if it stays on your books, is the liability. Because you've taken in money and you haven't fulfilled it yet. So at some point, you might still have to give that money back. So that's your liabilities. And then equity. Your equity. What is it? Oh my goodness, it just went blank. It's a really simple formula. Assets minus liability equals owner's equity or equity. And that is what the balance sheet does, is it lists all of your bank accounts, all of your investment accounts, all of your properties and all that good stuff under your assets. Lists all of your payables. Oh, also your receivables are assets as well, by the way. That's kind of what I was talking about with contracts. Those are assets, they're receivables. Fancy word for it's money someone's promised to give you. They're your receivables. And your payables are the liabilities. And basically when you take them together, you have kind of a rolling balance. It gets a little more complicated than that with retained earnings and all that good stuff, but all retained earnings is at the end of the year, you count everything up, you zero out all your accounts, and roll it into one account called retained earnings, and that retained earnings either adds to your equity or it subtracts from your equity based off how you did that year and how much after taxes, basically. So, and that's an interesting thing too. Most people have no idea how businesses pay taxes. They don't realize what they're like. Oh, they'll just deduct it from their taxes. Well, yeah, it doesn't mean they get to not pay that much on their taxes. It means that they didn't receive that funding that they thought they were going to get.